Running a small business is exciting, but it also means you wear many hats. You focus on sales, customer service operations, and growth. But when tax season comes, it can feel overwhelming. One of the biggest mistakes small business owners make is leaving money on the table by not taking advantage of all the tax deductions available to them. These deductions reduce taxable income, which means you legally pay less in taxes and keep more of your hard-earned money. The problem is that many deductions are either misunderstood, overlooked, or underestimated. In this breakdown, we will explore the top tax deductions small business owners often miss, why they matter, and how you can use them to your advantage in 2025 and beyond. The power of tax deductions. Before diving into specific examples, it is important to understand what a deduction really is. A tax deduction reduces the amount of income that is subject to tax. For example, if your business earns $100,000 in revenue and you have $20,000 in deductible expenses, you only pay taxes on $80,000. Deductions are not loopholes or tricks. They are built into tax codes to support businesses. Governments know that small businesses drive economies, so they encourage investment and spending through deductions. The key is keeping proper records so you can confidently claim what you deserve. Home office deduction. One of the most overlooked deductions is the home office. Many small business owners who work from home skip it because they think it is too complicated or that it will trigger an audit. In reality, if you use part of your home exclusively and regularly for business, you qualify. This could be a dedicated room, a converted garage, or even a section of your basement. The deduction covers a percentage of rent or mortgage interest, utilities, property taxes, and even insurance. There are two methods to calculate it: the simplified method, which is $5 per square foot up to 300 square feet, and the regular method, which uses the percentage of your home devoted to business. This deduction can save thousands every year if claimed correctly. Vehicle expenses. If you use your car for business, you can deduct vehicle expenses. This is another deduction people often underestimate. There are two methods here as well: the standard mileage rate and the actual expense method. The mileage method gives you a set amount per mile driven for business, which in 2025 continues to adjust with inflation. The actual expense method allows you to deduct a percentage of gas, repairs, insurance, and depreciation based on how much you use the car for business. What trips qualify? Driving to client meetings, traveling between work sites, picking up supplies, or going to the bank for business reasons all count. What does not count is commuting from your home to your primary office. Startup costs and education. Another commonly missed deduction is startup expenses. Many people do not realize that the money they spend before officially launching their business, like market research, website development, or legal fees, can be deducted. The tax code allows you to deduct up to $5,000 in startup costs in your first year, with the rest amortized over time. Similarly, education and training expenses are deductible if they improve your skills or maintain your current business. Courses, certifications, workshops, and even business books count. If you are learning to expand your services, those costs are part of running your business and reduce your taxable income. Retirement contributions. Small business owners often forget that they can set up retirement plans not only for themselves but also for employees. Contributions to plans such as SEP-IRAs or Solo 41ks are tax deductible. This means you are saving for your future while lowering your tax bill today. For example, with a Solo 41k, you can contribute as both employer and employee, allowing much higher limits than a standard IRA. Many owners skip this deduction because they are too focused on immediate cash flow, but it is one of the smartest long-term strategies to lower taxes and build wealth at the same time. Health insurance premiums. If you are self-employed, you can deduct health insurance premiums for yourself, your spouse, and dependents. This deduction applies whether or not you itemize deductions. It covers not just standard medical insurance, but also dental and long-term care insurance. Many entrepreneurs forget this deduction and assume it only applies to employees and larger companies. It can be significant, especially as healthcare costs continue to rise. Business meals. Meals are another area where small business owners leave money behind. You cannot deduct personal meals, but when meals are directly related to business, they are eligible. This includes taking a client to lunch, meals while traveling for business, or food provided at a company event. In most cases, the deduction covers 50% of the cost, but if meals are provided as part of an employee event like a holiday party, the deduction can be 100%. The key is documenting who you were with, the purpose of the meal, and keeping receipts. Travel expenses. Business travel is fully deductible when it is ordinary and necessary. This includes airfare, hotels, rental cars, taxes, and even tips. Many owners forget to include smaller costs like baggage fees, Wi-Fi charges, or conference registration. If travel combines business and personal time, you can still deduct the business portion. For example, if you fly to attend a 3-day conference and then stay 2 extra days for vacation, the airfare is deductible, but the vacation days are not. Proper records ensure you maximize this deduction. Utilities and communication costs. Another deduction that gets overlooked is utilities. If you rent office space, electricity, water, and internet are deductible. Even if you work from home, the portion of your utilities that supports your home office counts. Phone bills are another area many people ignore. If you use your personal phone for business, you can deduct the portion of the bill that applies to business use. Over time, these small recurring costs add up to a significant deduction. Software and subscriptions. In the modern business world, software is essential. Whether it is bookkeeping software, customer relationship management tools, or project management platforms, these are deductible expenses. Even subscription services like Zoom, Canva, or Dropbox count. Many owners pay for these monthly but forget to log them as business expenses. In 2025, with so many businesses relying on digital platforms, this deduction is more relevant than ever. Professional services. Accountants, lawyers, consultants, and even coaches fall under deductible professional services. The cost of hiring experts to help your business succeed is fully deductible. This includes tax preparation fees, which means the cost of hiring a professional to help you identify deductions is itself a deduction. Too many business owners skip this category because they see it as an optional expense. In reality, professional guidance both improves your business and lowers your taxes. Advertising and marketing. Money spent on advertising and marketing is deductible, yet many small businesses fail to record everything. This includes paid ads on Google or social media, printing flyers, business cards, or even sponsoring a local event. In today's landscape, digital marketing costs can be significant, and every dollar you spend to attract customers reduces your taxable income. Even small costs like domain registration or email marketing subscriptions belong in this category. Bank fees and interest. Bank fees and interest charges are often forgotten. If you pay monthly fees for a business checking account, credit card fees, or merchant processing fees, these are deductible. Similarly, interest on business loans or business credit cards is deductible. Personal fees are not, so again, separation of accounts is critical. By keeping everything in a business account, you ensure you can track and claim these easily. Depreciation. Depreciation is a deduction many owners overlook because it feels complex. When you buy assets for your business, like equipment, vehicles, or furniture, you cannot always deduct the full cost in one year. Instead, you spread the deduction over several years as the asset loses value. This process is called depreciation. In some cases, tax codes allow accelerated deductions through sections like 179 in the US, which means you can deduct the full cost up front. Understanding depreciation ensures you do not miss out on large deductions for major purchases. Employee benefits. If you provide benefits to employees, those costs are deductible. This includes health insurance, retirement contributions, childcare assistance, or even wellness programs. Many small business owners think benefits are only for large companies, but even small teams can take advantage. Providing benefits not only helps with taxes but also attracts and retains talent. Bad debts. Another overlooked deduction is bad debts. If a client does not pay and you have already recorded that income, you may be able to write it off. This applies to businesses that use accrual accounting, where income is recorded when invoiced rather than when paid. Writing off bad debts ensures you are not paying taxes on money you never actually received. Continuing education for employees. If you pay for employee training, courses, or certifications, those costs are deductible. Many business owners do not track these expenses closely, but they qualify because they help maintain or improve skills needed for the job. Miscellaneous supplies and office expenses. Finally, do not overlook small, everyday expenses like pens, paper, coffee for the office, or cleaning supplies. These seem minor, but they add up. Every dollar matters when it comes to reducing taxable income. The importance of documentation. Claiming deductions is powerful, but you need proof. The best practice is to keep receipts, invoices, and digital records for every expense. Many accounting tools allow you to snap pictures of receipts and automatically categorize them. Consistency is key. If you ever face an audit, detailed records will protect you, bringing it all together. When small business owners ignore these deductions, they pay more tax than they should. But when they take time to track and claim them, the savings are huge. Home office, vehicles, startup costs, retirement contributions, health insurance, meals, travel, utilities, software, professional services, marketing, bank fees, depreciation, employee benefits, bad debts, and supplies. All of these add up to thousands in savings every year. Imagine this: two businesses make the same revenue, but one owner carefully tracks deductions while the other ignores them. The first pays far less tax and reinvests the savings into growth. The second loses money unnecessarily. Which one would you rather be? Thank you for staying with me through this deep dive into the top tax deductions small business owners often overlook. If you want more practical guides that make business and money simple, be sure to subscribe to our channel Success Lens, so you never miss the strategies that help you save, grow, and succeed.